Hello and welcome. Thank you for joining us. Today we have a very special guest with us, Ajit Dayal, founder of Quantum Advisors. Ajit, thanks very much for joining us.
Thank you, Sarit, for having me.
Ajit, you've said that you made your very first investment in the stock market in the year 1977 and you lost money on that. What were your takeaways? What did you learn from that experience?
Well, it was a long time ago, nearly 50 years ago, I guess. And I'm happy that I lost some money then and have lost a lot less money after that. So the takeaway was that, it came in from a tip.
Okay.
My father had this friend, and this friend was, having playing cards with my father and having a chat with my father. And we just started talking about stock markets, and somehow he said, "Oh, you should be buying this stock." And I was didn't even know what a stock market was in that days. I knew pretty much what a stock was, but not how stock markets work. And, went to the stock exchange, asked my father his broker's name, went to the old structure of the BSE. There was no trading ring in those days. You had to shout and hold each other when you bought and sold shares. And so I just went there and I bought the share, and, someone told me to buy it. So I bought it and I lost money. So obviously many, many learnings from that. When someone tells you something, sure, you must listen, but you need to understand what exactly you're doing. You need to analyze and think about things yourself and see if it has some sort of inkling of sense in it, and then act on that information, if you want to call it that. So there were many lessons from that. The other lesson was, of course, that India was a very khabar-driven stock market at that point in time. So everything was insider trading. There was no research. There was no data on Indian stocks. There was no database that you could look at. There were no graphs that you can access like you do today. So clearly it was pure khabar. And there were a few insiders who knew what was happening, and they were effectively speculating in the market on how the market would react to news when that news was released. So in today's day and age, very different, right? Yes. You still have a bucket of people who will buy and sell shares based on information, inside information, if you want to call it that, which is illegal. But a large, vast majority of people are buying shares based on analysis, views, and some thought behind it.
Ajit, you've said that your father was a very big influence on you while growing up. Could you share a very important lesson that he imbibed in you at a young age?
So my father was a doctor, a GP, and he had his own little clinic on A Road, Churchgate, right near Jai Hind College. So I watched him, as I was growing up, I watched him work hard and set an example about hard, working, and a work ethos, if you will. But the most important thing is when I went to study in the U.S. in 1981, he gave me a letter which he said I should not open until I reached America. So I reached my university, opened the letter, and there were 4 words that he wanted me to, listen to and imbibe in me, if you will. And those were be good and do good. And those 4 words were what his school teacher told him when he left Sindh, which is now in Pakistan, to come to India, to come to Bombay, which was then Bombay and now Mumbai, to study medicine. So his school teacher told him, be good and do good. And those were the 4 words that my father told me that should be my guide and my beacon as I carry on my life. And those words to me are extremely important. And I pass that on to my children.
These 4 words, be good, do good, how did they influence your investing philosophy?
So the be good, do good factor is important when you try to invest in companies who, what we call governance, who are doing things for all shareholders rather than only doing things for the largest promoter, founder shareholders. That's a big distinction. Once you own a share in a listed company, you have the same right, proportionate right to profit as the largest shareholder, as the founder, no matter how many decades ago they started the family. Once they list the company, that's it. Everyone has the same proportionate right to share, right to profits, and I think that be good, do good comes from there. If founders of companies have good behavior and they get into businesses that are legitimate, that are profitable obviously over time, but also are learned to share in the correct proportionate way to all shareholders, those companies will do well. But companies where the founders effectively try to take away extra profits through what we call related party transactions. Some may be declared, some may not be declared, and they're effectively stealing from the minority shareholders. Those are companies which one needs to avoid.
Ajit, you've often spoken about black sheep in the Indian business community and in the stock market. For the retail investors watching this, how can they imbibe the be good, do good philosophy in their investing?
So the world has changed dramatically. In 1979, while drinking Campo Cola and while eating chivada, I came across a Mad magazine, which was very famous in those days, which had a cartoon. And the cartoon was, one black sheep standing among a crowd of white sheep. And all the white sheep are looking disapprovingly at that one lone black sheep in the center of the crowd of white sheep. And it said, then and now. And the now next page was, on the same page at the bottom was one white sheep standing in the middle and all black sheep surrounding it looking at strangely at that one white sheep. And obviously black and white indicates white sheep is someone who's good and black sheep is someone who's not good. And that was in 1979. So fast forward today, obviously the world has become more focused on money, less focused on values. And I think that's a dramatic change. So from an investor's perspective, I think the way you look at your children, the way you'd like your children to grow up, people of good character, those are the kind of companies you should invest in. Founders and principals with good character, founders and principals who not only have integrity, but they have competence. They're able to build businesses, they're able to make profits, and they will certainly ensure that you as a minority, as a retail investor, will get a fair share, a fair proportionate share of the profits you deserve based upon the percentage shares that you own in the company. And I also tell my kids the same thing. I tell them that when they go out and build their life in the future, they should really have this be good, do good philosophy around them. And that to me is more important than me telling my kids that you should become, very rich. Very rich doing what? Doing bad things? Then I'd rather not they be rich. But if they do good things and if they lead a noble life and a decent life, that to me as a father would make me happy. In a very similar way, this whole thing about returns, there's a risk to returns. There's multiple risks to returns at so many levels. And I think investors need to recognize that they need to invest in companies, again, which I said, integrity and competence both matter.
Ajit, thanks so much for joining us today. It was a very enriching experience.
Thank you again for having me. It's a small 4 words, but very powerful 4 words. And I hope that the viewers take that to heart when they make their investment decisions.